Hey everyone, welcome back to Corporate Decoder, the place where we dig through the dry stuff so you don't have to. Today we're looking at Voya Separate Portfolios Trust, and believe me, this report has enough jargon to make your head spin, so you can say we are decoding it for you. This filing is a certified shareholder report, which at its core summarizes how Voya's funds performed and what they invested in over the last year. It's like a report card, but instead of grades, it's dollars and cents, and whether those dollars went up or down. So follow along to know how these funds are doing. And if you appreciate straight insights from corporate documents, don't forget to subscribe. We also have a Discord community. The link is in the description below, so you can geek out with me and other corporate decoders on this and other reports. First up, let's get the basics out of the way. This filing is for Voya Separate Portfolios Trust, a registered management investment company. Think of it like a container holding different investment options. And the filing date is March 31, 2025, so this is pretty current as of today, covering the period from April of 2024 through March of 2025. Now let's jump into the details of one of their funds, Voya Investment Grade Credit Fund. This fund primarily invests in investment grade corporate bonds. The goal is to provide a steady income stream while maintaining a relatively low level of risk, well, relative to all other risky investment options. For their Class A shares, trading under the ticker VACFX, the report dives into the fund's costs and performance. It's like checking your car's MPG and maintenance record. Let's see if it's worth the price. Here's where it gets interesting. If you had a hypothetical $10,000 invested in Class A shares of the Voya Investment Grade Credit Fund, your cost for the year would have been $91 or 0.10 to 90%. That is below 1%, not too bad for professional management. So the team didn't take too much of your investment, so what did they do with it? The report notes that the fund, before fees and expenses, outperformed the Bloomberg US Corporate Bond Index. Basically, they did better than average, mostly because of selecting good investments in the banking and insurance sector. Added to the returns, while pharmaceuticals, communication, transportation, and technology drove industrial returns, what took away from the performance of US Treasuries. Digging into some more specific numbers, their average annual total returns table shows Class A shares had a 5.11% return, excluding sales charges for the past year. Over 5 years, it's down to 1.6%. It's good for an annual, not so good to have held for the whole 5 years. That's a lesson. Constantly monitor your investments, even if someone else is doing it for you as life happens. It's also worth noting the report mentions a change in their primary benchmark from the Bloomberg US Corporate Bond Index to the Bloomberg US Aggregate Bond Index to the Bloomberg US Life Happens. Also worth noting, the report mentions a change in their primary benchmark from the Bloomberg US Corporate Bond Index to the Bloomberg US Aggregate Bond Index, done with the changes to disclosure requirements. So always double check your past returns with the new values to make sure there are no accounting shenanigans. A few other quick stats. Total net assets for this class were roughly $84 million. They had 700 holdings. The portfolio turnover rate was a whopping 469%, meaning they traded a ton during the year, and advisory fees paid out were $212,303. As a percentage of fund statistics, that's about there at 0.25%, which is in addition to the cost already mentioned. Where did they put all this money? Their top 10 holdings at the end of March had the United States Treasury notes as number one, with about 2.8% of all net assets, followed closely by 1.9% of United States Treasury bonds. The others are large and well-known holdings. This is a safe fund, not too risky in terms of investment grade credit. Moving on to another class of shares, the Class I ticker VIXX has some differences. Both of those class costs were lower, with the expense ratio at 0.65%. That means if you had invested $10,000, you would have only paid $67 in expenses for this fund. Why are they so different? It may be that the investors in Class I can have different agreements with Voya than those for Class A. So for more details, check it out. For a $250,000 investment, the total return has been over $300,000. That is great, however, past performance does not guarantee future results. Always read the fine print, folks. Their average returns are also pretty similar, but just slightly above Class A. So always check different classes before investing. Next in line is Class R6, ticker VIGTX. This class is even cheaper than Class A and I, with the expenses being about $65 per $10,000 invested, or 0.63%. Their total return graph of a $1 million investment does similarly to other investment classes. And finally, Class W, if you had a $10,000 in that class, you would have paid the same as Class I, with the expenses for the year being about $67 or 65%. Again, pretty similar returns as other classes. Now let's move on to another fund. The Voya Securitized Credit Fund, Class A ticker, VCFX. This one's a bit different, focusing on securitized credit like mortgage-backed securities. 5G, if you had $10,000 invested in this, your cost would have been $104 or 1%, which is higher than Voya Investment Grade Credit Fund. This means it can be harder to gain returns as this fund takes a bigger cut. According to the annual report, the fund outperformed the Bloomberg US Securitized MBS Index. From a sector allocation perspective, the allocation to non-agency residential mortgage-backed securities, RMBS, contributed to the sector allocation. So let's jump into those numbers. For a $10,000 investment since 2015, they report steady positive returns. So the average annual holdings with 30 for the past year, they are showing 8.25% return, excluding sales charges, 5.38%. For the past 5 years, Cento Top 15, they report steady positive returns. The average annual total returns paints a great picture. For the past year, they are showing 8.25% return excluding sales charges, 5.38% for the past 5 years. Dow total returns paints a great picture. For the past year, they are showing 8.25% return excluding sales charges, 5.38% for the past 5 years. Total net assets in this fund is substantial at 51,190 fund in plenty. Their top 10 holdings mainly consist of RFM Re-Remic Trust, Symphony CLO Subway Funding LLC, with most holdings at less than 1%. Seems pretty diverse and low risk again, given the investment grade. The Class I ticker is VCFAX. It has very similar features with some slightly lower expenses at 0.68%. Looking through all their funds, the story is relatively the same, with some minor changes to expense ratio, all well maintained. Now let's look into another fund, Voya Vex Series EMHCD Fund Portfolio. This fund invests in emerging market debt. And if you had $10,000 with these guys for the year, it would have cost you a whopping $15 or 0.14%. This has to be the cheapest fund I've ever seen. This fund outperformed the JP Morgan EMBI Global Diversified Index. What helped? Overweighting in Latin America and selection in Chile, Mexico, and Panama. On the detraction side, underweighting to sovereigns versus an overweight to emerging market EM corporates. Here's where things get interesting. For the year, they posted 7.54% and 10.15% since inception 2 years ago. Their portfolio turnover is at 124,700, 12,600, 24,791. Their top 10 holdings had each about 1% invested to Petróleos Mexicanos and Bahrain Government International Bond, followed closely by Romanian Government International Bond, followed closely by Romanian Government International Bond. So it's good to see they invested in smaller but lucrative locations. And here is another fund, Voya Vex Series SC Fund Portfolio. If you're looking over all of these holdings, their financial numbers and investment directions remain relatively the same. What is great news? Alright, now a turn into legal land. The funds have a code of ethics for their principal officers. This code is to make sure that there aren't backdoor deals and to avoid any conflicts of interest. Looks like the code was clean, with no changes or waivers reported. They've also got audit committee financial experts on the board. These people are financially savvy and independent, meaning they don't have any conflicting interests that could cloud their judgment. What did the accountant cost Voya? It was $90,425 for auditing their financials and $40 for tax compliance. In total, about $130K, which for a company of their size is standard procedure. They also have a robust policy for pre-approving any work for their auditing team, so they don't stray into consulting and lose their independent voice. Alright, after all that report diving into coding, let's zoom out for some final takeaways. While Voya Investment Grade Credit Fund shows steady, if unremarkable performance, the Voya Securitized Credit Fund is the star, offering stronger returns, albeit at a potentially higher cost. I did not see any concerning changes to the expense ratios or turnover ratios. However, legal and ethical standards look strong and stable. And the investment seems pretty safe in terms of holdings that are all investment grade. I might be a bit wary if I was seeing a lot of smaller companies, but again, make sure you do your own research. Well, that was our deep dive into Voya's shareholder report. What are your thoughts on how these funds are managing their investors' money? If you appreciated this breakdown, make sure to hit that like button and subscribe for more straight talking corporate analysis. Also check out the Discord community in the description, and I'll see you in the next one.